thank you for accepting the EY report at this conference today. I don't want to take more than 10 minutes, frankly, about the report because most of it is in there. Just a few observations from whatever I heard since the morning, and a lot of our report actually talks about it. One is, there's a great adage called health is wealth. And here we're here to discuss, frankly, the health of wealth. So let's kind of discuss that in more detail as to what we are all about. Again, I heard some conversations and have some views around two things that got discussed in the last panel. Point number one is that when do we graduate to be a doctor? My question is, yes, it will take time. It will take those 5 years to actually become a doctor. But till then, can we just be credible chemists? Because by the way, every chemist also has a regulation to abide by. And most chemists don't abide by it. You're supposed to dispatch medicines with a lot more discretion, with a lot more care. None of that is done. Maybe as a start, if we did that, that culture will come in to actually do things much better as we go on. The other thing is that somebody mentioned that nothing is in our control. How do we kind of manage the business? Very aptly answered by Arpita. But just one more point. The biggest thing in the control of any IFA is the customer. And frankly, if we can understand that customer better, everything else falls in place. It's not your job to identify, frankly, which assets to invest in. It is, of course, in a way, because you measure performances of mutual funds. But at the end of the day, the bigger part is the fund will perform as the market performs, as the economy performs. But what you know is what your customer wants. I'll link that to our report. If you look at our report, the customer preference has moved very significantly to being much more conservative than much more aggressive. Globally, frankly, that has been a trend after especially the 2008 debacle. Most people have said, let me conserve cash. The baby boomers generation, as they called it, which was the 1946 to 1965 bonds, are actually now near retirement. Any which way, they, who were earlier very aggressive equity and bond investors, are actually now becoming retirement investors. The new age has had such a bad experience, thanks to the debacle of 2008, that they've become more than conservative. In India, frankly, also we've seen equity debacles up and down. We have credibility issues. We have many such issues as has been spoken about and will be spoken about today, and it's all there in the report. We have to make sure that we are more conservative. Our research actually shows that most people are not looking at outperforming indices anymore. Most people are looking at a good mix of safety. A lot of people are looking at how do you ensure stability. I'll give you my personal example. And I stand here as a consumer, not as an asset manager. But as a consumer, I have an IFA, frankly, who has advised me, not now, but 10 years back, what I will be in my retirement. What are the options I will have? How do I need to get insured? How do I need to make sure that I get cash at the right time in my lives? And it is not about equity. It's about equity, it's about debt, it's about insurance, it's about many other things. Now we have much more. But that advice, if I look back 10 years, I see the genuineness of that advice that was given. And frankly, today, if that guy were to ask me for a fee, I would pay him. This is where we need to go. Global regulations, as highlighted again in the report. The UK came out with the retail distribution study. And as part of that, they said that there will not be commissions. There will have to be fees. India, SEBI came with that too. Very rightly so. And yes, there was lots of debate at that point in time in India, I remember, to say that, it's very difficult for a customer to write out a check. Frankly, if that customer has had a great experience, as I just spoke about, you will actually find that that customer will write you a check. Increasingly, as newer products come by, alternative investment funds come up, other investment funds come up, where there will not have been a proven success track record. People will work with you on success fees. So I know, for example, now thematic equities are coming about. A lot of people are trying to do a lot more, not necessarily on funds, but stock picking. There are enough IFAs who actually do stock picking and say, we will create a pool of assets for you which go around a particular theme. And those themes are unproven today. And though the fee structures there are success. I will give you a hurdle rate, typical to a private equity. I'll give you a hurdle rate, and beyond a hurdle rate, you charge me success. Proven fees. My view is, that credibility has to be established. There are no shortcuts. It's been proven globally, it's been proven locally. Are there fee pressures globally? Yes, they are. Are there fee pressures locally? Yes, they are. We're not going to be decoupled. Our industry in India and globally, frankly, the trend is that people are wary of paying fees. People have the trust issues thanks to the 2008 crisis. The same issues are there. We have the same issues in India. The difference in India is, as somebody also said in the panel, a lot of it is gold and real estate. We need to shift that into investment. As Rashesh said, when we moved into investments, when we move into equities, when we move into IAFs, ETF type investments, when we move towards specific funds, we will find that there is going to be a lot more change in the way the fund management moves, the way the structure of the fund is. And that will change in India because increasingly from entrepreneurs, which are the bulk of the Indian HNIs today, we will move to professionals because that class has come up over the last 10 years. And over the last 10 years, you're seeing that that class is investing much more. They are far more transparent. They are far more fair. Hence, we see the fee structures going up. We see diversification of investments outside of real assets happening. And once that, frankly, happens, this is where the economy will actually see much more. So the profile of the investors has to change. So we will basically have a lot more share of professionals, a lot more share of inheritors who will want to invest their assets in better areas. And most of these areas where they're going to invest their assets are going to be on the conservative side. The professionals will be more on the planning side. So if you combine financial planning with maintenance of assets, which is coming from the inheritor side, these are two large categories. They are categories who are increasingly turned professional, and they are categories who will effectively look for a diversified portfolio. When they look for a diversified portfolio, frankly, as newer asset classes come, they will be amenable to pay success fees. Older asset classes, they will pay you a fee. So frankly, we see that this model will evolve over a period of time. As far as what is happening globally and the model will change in India, is increasingly costs are under pressure. So while, of course, the business model has a revenue element, the other element is the cost element of this whole thing. And for cost, frankly, there's lots more outsourcing that's happening. If you look at Deutsche Bank, they have basically outsourced to a firm called Avaloq the whole operations management globally. Why will that not happen in India? With increasing technology, there will be a lot more on the digitization part. And India will adapt to digitization more fast than anybody else. In fact, I was talking to somebody else, and this is a little bit on the financial inclusion side, may not be as relevant to you guys, but it is relevant in terms of where we're trying to push literacy for a while in India. Once the mobile phone starts getting used as a bank, small payment banks, small banks, payment banks, etc. coming through, you will find literacy will increase in India like anything because people will at least learn how to read mobiles. They may not go to school, but they will know how to read a message on a mobile. That is literacy, and that literacy will create awareness, not only at the micro level, but at the less affluent and the mass affluent level. And that is where your transparency will increase. People will see much more in terms of products, and people will demand much more in terms of services. So frankly, that is the changing landscape, especially with digital. The way to actually garner customers at the IFA level or the fund level is to build a great analytics base. What are people looking for? That is where you really sell the service. What am I looking for as an investor, as a 50-year-old person? What am I looking for? I would be looking for security of my kids. How do I invest the assets in there? What have other people done? If you're able to garner a lot around analytics, we will see a lot more change, a lot more value add that an IFA or a fund manager can actually provide. A lot more productization will happen. Today we have many, many products, yes, but a lot of them are similar. We will need very specific products which meet a particular person's needs. Once we do that, I think this is all there in the report. This is really what will change things. So frankly, with that, I'd like to say that please do read the report. It has a lot more that can change. Operating models can change over a period of time. And we will hopefully see that this industry will turn profitable over a period of time with a lot of credibility coming in. Thank you.
Thanks so much, Abhizer, for sharing your thoughts. I'd like to call on stage Ajit Menon from Tata Mutual Fund. Sorry. Sorry, we have Ravi Trivedi to help us felicitate Abhizer. Thank you so much.
Thank you. Very nice, scary report. Lots of opportunity, lots of scary stuff in it. Just as a slight humorous aside, the introduction of the report was accompanied by the Star Wars theme, which is a little, disconcerting, because I hope that's not where this thing is heading. Abhizar, given the massive opportunity that you highlighted in the report for India, but also the significant gap for that opportunity to be served I would not even say short term or mid term, even on the long term side, given the fact that we are losing advisors, we don't have enough penetration. What's your take? What do you see? How do you think this gap is going to really come together?
Yeah, so one thing, Ravi, frankly, is that yes, there is a gap and there is no gap. Where there is a gap is in terms of formal advisors. There is no dearth of informal advisors in India, frankly. India has many, many more informal advisors whom people trust. Those informal advisors need to come on board and try and become more formal advisors. And what we see is that that is the same transition from a Hakim to a chemist to a doctor, I would say. And frankly, that Hakim is now transforming to a chemist quite fast. And over a period of time, that chemist will gain the qualification to become the doctor. So frankly, I think there is a lot of informal advice. The big gap is that the trust factor in the informal advice is far higher. and the trust factor in the formal advice is much lower.
So, Abhizar, let's assume that you were, you had the opportunity to advise the regulator. and part of the challenge that we are seeing with the advisory part of this business is that the regulator has stepped in and put in a whole set of norms around the control and the ability to be able to give good advice. What would you tell SEBI or AMFI in that to some degree on helping in actually expanding this scope and expanding the reach of these of these advisors across? And I'm not talking about only Mumbai. I'm talking about deeper into the markets.
See, again, this is akin to the financial inclusion or priority sector lending that we have in banks. It has to move with a business proposition. And I think that business proposition will come with digitization. Everywhere in financial services, whether it is NBFCs, mutual funds, banks, small finance banks, payment banks, whatever. I think all of them are going to have a asset management module within them. And that itself will create the business case for the penetration of services. Coming to the regulator, I think the regulator has been pretty much following what the global regulations does. We had the MiFID regulations in the UK, which has resulted in SEBI coming out with the rule that you need to start charging commissions rather than charging fees as against commissions. Yeah. The other issue has been around RBI now trying to say that you subsidize your asset management businesses. I think all this is a move towards transparency. What is the right balance is that the cost of compliance should not exceed beyond a point.
Exactly.
And when the cost of compliance exceeds, which is where we will have a problem. Now look at countries like India, frankly, we are going to get more impacted. One of the things I'd like to raise, why are the global firms actually leaving India? I mean, they get so complex for them. Look at HSBC, when they got stuck in this whole account opening issues. At the end of the day, when we have regulations which talk about global sharing of information around tax globally, we have FATCA. We have some of these kind of rules globally which are impacting us. Increasingly, in a country like India, which is transforming, which has a parallel economy which is equal to a normal economy, for them, the transition in terms of regulatory compliance will be tough. Yeah. But that transition has to happen. And frankly, we are going to go through that. We'll have players who will go away. Maybe the market matures. Some of those players will come back. But the Indian players are by far the best suited to manage this because you're not managing that much of overseas money. You're pretty much managing a lot of domestic money which will be garnered. And as I said, as the professional class moves up, the income transparency is that much higher. And that much the pool gets larger, as far as the financial advisors are concerned.
So if you had to take an educated guess, let's look 5 years down the line or maybe 10 years down the line, what model do you think, whether it's bank-led or an IFA-led or a specialist wealth manager-led, what model do you think has a better chance of success across, I would say, the professional asset classes? I mean, professional asset, creators, but also the new wealth that's being created in the, in the small, medium enterprise kind of areas?
Frankly, I think that the only model that will work is customer-led. Now, if the bank adopts the right level of analytics to capture a customer, they will do it. An IFA can do it as well. But it will completely, the whole financial services landscape, including asset management, is actually going to move more towards customer-led. I mean, think about fintech. Fintech is the biggest customer-led threat that this industry faces. Because once fintech does analytics right and owns a customer, everybody else will remain to be a booking vehicle.
Yeah.
You can have your own mutual funds, you'll be a booking vehicle. It is the fintech which will decide where you go, or the IFA, as long as he knows his customer well. So I think any model, a bank's model can fail. A bank has reach, but reach, frankly, irrelevant given mobile banking that's going to happen now. So frankly, at the end of the day, if you look at 3 to 5 years, I would say customer centricity is by far the most important business model that will happen.
But from a cost perspective, because that eventually, from a profitability perspective, you have the reach part, you have the income part, but you also have the cost perspective. And from what we have seen, is that in India, given the sensitivity to pricing and to the commissions paid, etc., the cost part is something that's going to be very critical going forwards, right? And which is what the last panel discussed, that global wealth managers had this issue of the cost that they had built up compared to what they, what they could sustain from an India perspective. Where do you see that ending up? Because eventually, as much as you can reach a customer and do that business, unless you manage your underlying cost structure to do this business well, you're not going to be profitable. And most people have quit this business because of profitability.
Right, so in terms of cost, I think this business will have two models which will go side by side. There is this HNI and ultra HNI model, which I think globally as well as in India, you will still need the IFA, the personal advisor. So that cost will be there, the branch cost associated will be there, the people cost associated will be there, the technology cost associated will be there. I think if you look at this whole model, the lower part, which is these $10,000 upwards, up to maybe $100,000, that category will get automated very fast. That automated cost is a fraction of the total cost today. So I think the function is that while you will get fees based on percentage of assets managed, that 90 basis points that people spoke about, I think we'll reach there. The cost side of it will have to be managed in two ways. The ultra and the HNI category, which is the 100,000 and above category, will be serviced. The ultra HNI will get serviced by individual interactions, less of technology, more of personal. The HNIs will be more of technology, less of personal, but will not be without person. While the below 10,000 to 100,000 will actually get completely automated, either on mobile or payments bank or small bank or whatever category you call it. It is the distribution cost there is significantly distributed along the chain, and RBI allows it, SEBI allows it. The cost allocations will have to be done well, because if you look at the model of the small and the payments banks, which is in my view the private sector led financial inclusion, which is what is really going to make money. Their business models are based on advisory services. So I think they will end up making money around that, and the costs will get sharpened. Of course, the quality of advice will have to be significantly better. And I think individual financial advisors will have to try and align to those technologies and those frameworks to be able to manage their customers.
So coming back to the technology perspective, you in your report you mentioned about the rise and the eventual advent of the robot advisors. Given the fact that your payment banks, your financial institutions that are moving deeper into the markets, will always have this lack of people. Right? I mean, or adequately skilled people. Where do you see technology eventually overcoming this entire challenge of that deeper penetration? I mean, you've talked about one level of, that the 10,000, you've categorized it by segment. But do you think technology will actually overcome and actually potentially kill off a number of businesses in the wealth management advisory, because it's just going to overtake all of their models?
Well, I think people will adapt to technology rather than technology take them over. And I think that will happen over a period of time. As I said, so some of the IFAs who are operating in midtown cities, I see them aligning more with the payment and small banks at some stage and share that infrastructure. They will own the customer. They will be the interface between the small bank, etc., and the customer. They will use that technology effectively. And there will be a lot of technology sharing. Even today, frankly, in the world, if you look at the 10,000 to 100,000 level, technology is shared. It's not owned. But as you move up, a lot of technology is specific. A lot of data analytics happens at that level, not necessarily at the consumer level. So that's where we are.
Okay. So just as a final question, let's assume we are sitting in the same conference 10 years from now. What will be the topics of discussion?
I hope not credibility and fees. No, but frankly, I think topics will be a lot around technology. I think there'll be a lot around newer ways to deliver, newer asset classes. You know, for example, India, we today own real estate. We own gold. But we now have real estate funds. We have REITs. We have gold-backed assets. There is liquidity. And those assets, while they are backed by gold or backed by real estate, they are managed by professionals, and the professionals have to better manage those assets. And I think we'll see a lot of that. A lot of people actually giving money to institutions rather than to buy assets. So, for example, if I buy a flat today, I'm taking the rent risk, the client risk, the regulatory risk, the taxes risk. If I invest in a real estate mutual fund, I'm getting the benefits of it, but I'm not taking the risk. I see that change happening. Institutionalization of savings is what I see 10 years later.
Very good. And you know, it took the US asset management industry to reach the $5 trillion assets under management. What's your take? What's the growth path that you see for the asset management industry in India? Where do you see us 10 years from now? I mean, in terms of the depth of or the maturity of the market.
Yeah, I mean, as I think somebody said, Pradeep said in the thing, that as an economy we are growing, say 30% savings. And out of 30% savings, we are also talking about, 20% of that going into financial savings. Frankly, a $400 million industry. That 400 million, I think, with the growth in GDP will increase. But the 30% savings may actually come down a bit because there will be consumerism. Yeah. So frankly, I see this growing at a decent CAGR, a little lower than what GDP grows, but significantly higher in terms of more and more savings coming through.
Excellent. So thank you very much. Any questions for Abhizar, please?